Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to go over the Fed's strategy to contain inflation, the reasons why they are embarking on this strategy, and why I believe it is a gross error in their monetary policy. So it's no secret now that inflation has spiraled out of control. The last CPI report that we had showed that the annual inflation rate has risen to 8%. And as I've noted before in a previous video, if we were to use the 1982 standard of the CPI inflation rate, it's probably really closer to 9 to 10%. And the Fed is obviously pivoted from the transitory remarks in 2021 where they said that this inflation was just going to go away as the pandemic eased. And now they are planning to engage in relatively tighter monetary policy in order to contain those inflation rates. Their strategy is twofold. First, the Fed plans to raise interest rates, the federal funds rate, that is, raise the interest rates on the short run. And second is to sell off assets off of its balance sheets, which have accumulated to a whopping $8.9 trillion. The Fed has added over $6 trillion of assets to its balance sheet from pre-COVID time, and that has had an effect of lowering long-term interest rates. So at first I was puzzled by their strategy here, because when we take a look at what happened the last time the Fed started to sell assets, which was in 2018-2019, they managed to sell off only $700 billion of their assets. And it nearly caused a liquidity crisis in the banks as the secured overnight financing rate started to skyrocket in September. And if the Fed had not set up their standing repo facilities to temporarily purchase back those securities that they were selling onto the market, more than likely it very well could have caused a situation where they would lose control over the federal funds rate, and we would see a rising federal funds rate, which would raise the cost of borrowing and throw the economy into recession, or it would force the banks to draw down onto their reserves to dangerous levels in order to combat that. I'm not really sure one way or the other on that, but I'm going to go over that on what I think caused this spike, and if the Fed's policies, now will cause, their selling of assets off the balance sheet will throw and create the risk of another spike in overnight financing rates, which could put upward pressure on the federal funds rate and force another banking crisis. At first, I was kind of puzzled as to why the Fed was doing this. Why sell assets on the long end of the interest rate spectrum and on the short end simultaneously? And the reason why I say that is because when we take a look at historical times, which was under the Paul Volcker chairman of the Fed administration back in the 1980s, what historically the Federal Reserve did was raise interest rates on the short end. Now, to be fair here, at this time, total assets held by the Fed, meaning long-term securities, were exceptionally low compared to now. I mean, going back all the way to 2003, there was only $600 billion on the Fed's balance sheet. Now it's $8.4 trillion in terms of just Treasury securities held outright. And in reality, and that includes mortgage-backed securities, and then in reality, there's some short-term measures there. So it's not entirely fair to compare that to Volcker. So Jerome Powell may feel like he needs to sell both ends of the spectrum. But in reality, what I think he's doing is he's trying to avoid a negative yield curve. So I've made videos before talking about this negative yield curve. That is, when short-term government treasury rates are selling at a higher interest rate than middle or long-term government interest rates. The common bonds that are used are the 2-year treasury and the 10-year treasury. We end up going into a recession. And if we follow this pattern going all the way to the 1970s, it's happened in every single one of the recession, and it even went slightly negative in August 2019 before we had the liquidity crisis of September 2019. So it's sort of kind of, put a little bit of proof there that there was some systemic problems going on in the financial sectors of the economy. And look what's going on now. We're seeing a tightening of the yield curve between the 2-year and 10-year Treasury rate. It's down now to about 0.25% difference between the 10-year and the 2-year. So what Jerome Powell is trying to do is sell assets on the short end of the interest rate spectrum and the long end of the interest rate spectrum to keep this yield curve from going negative. But as I pointed out before, I believe this is a grotesque error, because until the federal funds rate is raised above the consumer price inflation rate, we're really not going to see a calming down in the inflation numbers. Why? Well, essentially, it's still cheaper to borrow, and consumers, which are what financing a lot of this consumer price index, are borrowing on the short end of the government bond spectrum, or really on the short end of the interest rate spectrum. So the federal funds rate dictates the bank prime loan rate, which is used to dictate, say, credit card interest rates, commercial loans, private loans, personal loans of that sort, as well as vehicle loans, and even to a degree mortgage-backed interest rates on that manner. So then why is Powell concentrating on the long end? It could be that Powell thinks that he truthfully knows that the reason why we're having such systemically high inflation is not just from personal consumers, but also from the federal government. And by punishing the federal government and raising government bond interest rates on both the short and long end, it'll force the government to curtail its expenditures, and that in turn will calm down the inflation rates. It's possible, but I'm maybe giving him too much credit. Instead, what I do think is that he's trying to avoid the yield curve from going negative. That's what I think he's doing. And unfortunately, when it comes to the private sector borrowing money from the long end, if they're issuing out, say, corporate bonds and such, those things are set for years for long-term, large-scale business projects that are usually going into producing capital goods, which enhance production and increase supply. So I don't think that curtailing the interest rate structure on the long end is really going to be beneficial to containing price inflation. Counterintuitively, it may actually work against that somewhat more than it works for that. But that's another story. But then what happens if the Federal Reserve causes another banking crisis like we had in September 2019? What are the risks of that? And at first I was, concerned about that could be the case. And so I decided to go in and actually do some math here. So I did the math on what happened with our financial situation from 2014 to 2019. And then I did it again and started projecting out what would happen to the bank's balance sheets, aka what would happen to their reserves, to kind of signal that there's too little liquidity in the banking sector that may force a default on banks or run on banks, or a spike in interest rates that causes a rise in defaults and delinquencies on loans. So starting back in 2014, total reserves in the U.S. banking system was about $2.8 trillion, a little bit more than that. During that time, by my estimate, savings, the amount of personal savings by consumers and businesses increased by about $2 trillion from August of 2014 to September 2019. But at the same time, government debt increased by $4 trillion. Now, why is this important? Well, if savings deposits increased by $2 trillion, that's liquidity that banks have to shore up their balance sheets. They have those as actual cash in their accounts, and they create loans off of those accounts, most certainly, but they have that on their balance sheets to as cash to sort of keep and maintain operations, and then pay back when they need to, when they're able to raise money after expenditures close. But government debt, it works as a negative to that, because what happens is that when the government wants money to spend, it borrows from the banks. So while private sector depositors deposited $2 trillion from 2014 to 2019, our federal government and our state and local governments sucked out $4 trillion from the banking reserve system. Now, normally when the government borrows money, it will just swap it out for reserves at the banks, and it would deplete those reserves. Now, out of that $4 trillion that the government debt sold to the banks, $800 billion of it was bought by foreign countries. So they were by foreign investors, and foreign central banks bought $800 billion of this dollar. So it really wasn't $4 trillion hitting the banking system. It's now down to 3.2. But to counter this, the Federal Reserve was engaging in tightening quantitative monetary policy, QT, quantitative tightening, and they sold $700 billion to the banks. So the banks were getting hit on both ends. They were first getting hit with the government debt of 3.2, then they were getting hit with the they were getting hit with the Fed selling $700 billion. So that total amount amounted up to about $3.9 trillion hitting the banks. But then by backing into the calculation here, when we look at the reserves of the banks at the end of September 2019, it only dropped to 1.6 trillion. So that means that about 700 billion was purchased by private investors in the US and hedge funds and investment institutions there. So if the banks were sitting on $1.6 trillion in September of 2019, what then caused the interest rates to spike? Well, the federal government has to collect taxes, and they collect them every quarter. So when we take a look at the quarterly tax revenue for the federal government, it amounted up to about $900 billion. Well, then that depleted the banks down to about $700 billion. Now, we may say, well, that's $700 billion. Again, that shouldn't cause a spike in interest rates, but you have to remember, some banks have that $700 billion. Not all banks do. So some banks were saying, hey, I'm depleted funds because the federal government, my corporations that had accounts at my bank had to pay quarterly taxes, and then there were private investors that had to do the same thing, and so on and so forth, as well as private businesses. I need to borrow money, and the banks who were sitting there with this remaining 1.6 trillion in reserves were like, hey, I don't have that money to lend to you. I'm not going to lend my cash out of my safe haven reserves to you unless if the interest rates go up. And I think that pressure is what caused this spike. So in other words, these reserves had dropped to such dangerous levels, and thanks to record government tax collections along with record government debt, it just put too much strain on the banking system, even with a net amount of $700 billion to sort of keep the wheels greased with money. So in my opinion then, if our bank's reserves get down to about $1 trillion or less, I think that's cause for concern that there's too little liquidity in the banking sector, and we could see a problem develop where there are issues with banks able to borrow money to maintain their operations, as well as to continue their financing activities, and it may cause a clog in our financial plumbing of the United States, and everybody is so dependent upon borrowing money for purchases and borrowing money for investments and borrowing money to engage in large-scale projects. So I think that's where the threshold there is. So taking a look at bank reserves now, total reserves now are about $3.9 trillion, a lot higher than the $2.8 trillion in August 2014. So what were to happen if we apply the same metrics here over time on an annual basis to how that will deplete bank reserves now that the Federal Reserve is no longer purchasing government debt with QE4? Well, first off, we have to factor in one, that right now the Federal Reserve has actually pumped so much money into the banking system that on a daily basis it is selling $1.6 trillion back to the banks on temporary market operations. So these are repurchase agreements, okay? So these are overnight repurchase agreements. In other words, the very next day, the Fed buys these back. But in other words, using this as a measure here, there's 1.6 trillion extra liquidity in the banking system that the Fed really wants to keep the interest rates where they are. So we know that the Fed can sell off about $1.6 trillion of its assets off of its $8.9 trillion balance sheet, and it won't really cause any systemic problems to the reserves in the banking system. Add to that savings will probably increase by about, say, $400 billion during this year's time span from January 2022 to 2023, and you get $2 trillion of liquidity there that is basically added to this $3.9 trillion reserves in the banking system. But now we have to counter some things. First off, we need to recognize that the government will probably levy $2.5 trillion against the banks this year. Okay? And this $2.5 trillion is coming from a $2 trillion deficit plus about $500 billion of interest on the debt that the government has to raise to pay its existing debt interest amount. So that's going to be about $2.5 trillion that it slams the banking system with, leaving a net difference of negative $500 billion. So then we need to factor in that governments around the world, foreign countries, will buy our government debt. Now, the last year, from 2021 to 2022, to December 2021, all the way through 2021, $700 billion of government debt was purchased by foreign banks. Now, there's no telling if we're going to get that again or if it will return back to the old age. As a matter of fact, I'm inclined to believe that it will probably get back to the old pattern of about $200 billion purchased per year. One reason is because rising interest rates deflates asset prices in treasuries, and so it causes losses. And two is that during 2021, I feel that foreign central banks were buying that U.S. government debt in order to shore up reserves and stock them away as reserves to be used as emergency lending in times of need for their countries during the wake of the COVID spread. And again, if there's another wave of COVID, we could see some spurring of buying from foreign banks again. Now, all that being said, given geopolitical situations developing, aka with China and Russia invading Ukraine, this can be brought to an end, and there could actually be some selling of U.S. government debt onto the markets there. And I may price that in just a couple of minutes, but I'll still continue. Then we need to factor in that hedge funds and private investors on the U.S. front will buy some of this debt, and then factor in if the Fed starts selling their assets at the rate that they were selling, at about half the rate that they were selling over the course of 5 years, if the Fed decides to engage and say sell off $300 billion by this year, which is probably a steep amount, but I would say that given their large balance sheet, they may do this. Then at the end of the year for January 2023, we're left with a reserve balance of about $3.5 trillion. Now, that may not sound like much, but then we have to remember that our federal government on a quarterly basis is going to be collecting taxes, okay? So this tax revenue is where things are going to be really problematic. Now, normally, when taxes are collected, they're replenished by earnings. So people will pay these taxes out of their accounts, but on a temporary basis for a quarter, it may provide a short-term strain on bank balance sheets as that replenishment still needs to be undergone. So if we factor in that there's $4.4 trillion of taxes now collected per year by our federal government, then we have to subtract that from the total reserves, leaving us a net difference balance of about $2.4 trillion on banks' balance sheets. Now that's higher than the $1.6 trillion here, so we're probably not going to be in any kind of trouble here. It's on 2 years out that we're really going to have some situations problematic situations develop, because now we're closer to this $700 billion net difference once we subtract out government taxes. So saying all of this, it means that, for a year to 2023, we're probably not going to have any problems in the banking system. But once we get to 2024, to January 2024, then we're probably going to be seeing some issues creep up in the banking system. And that seems to coincide right with my debt default model, because in my debt default model, I have it that in Q1 of 2023, interest rates the federal funds rate will be so high, it'll reach at 1.5%, that it'll be too much for our economy to handle. And since there is a delay now with the model and actual debt defaults increasing, and I'll bring that up right quick. We have to price that in. So originally I was thinking that based off of this delay in the rise in my model and the rise in delinquencies and defaults on loans, it'll probably take another year or two for this to manifest out. So we're probably not going to have a crisis on the default rates front until, say, 2025. And using this math here, we're probably going to have some problems in the banking system in 2024, 2025 with the Fed's methods here. But then the real issue is that even though the Fed will cause some situations with liquidity and a problem developing from there, unfortunately, it's not really going to take care of the inflation rate. So essentially, we're going to have the worst of both worlds. We're going to have the 1970s inflation rate, and we're going to have the banking crisis sector of the 2008 and 2019 and 1929. It's literally a merging of the 1970s and the 1930s. The Fed has stuck between the rock and the hard place and has decided to bash itself against both. We're now going to get slammed with both a credit crisis and a bursting of a credit bubble, and we're still going to have rising inflation all the way until then and not a calming down in that. Now, it's true that once the credit bubble burst, that might bring down the inflation rates temporarily, but then what's the Fed going to do with the banking system? Is it just going to let the banking system fall apart and we're going to have a run on the banks like we did in the 1930s? Probably not. Modern conventional thinking is that it will probably print money, put it into the banking system, flush it with liquidity, provide emergency loans out to everybody and anybody. The government will engage in massive stimulus, and then we're going to have rising inflation rates again, and we're going to go through this all over again. So this is going to be a very volatile, crazy decade, and it is going to be a bullish case for precious metals and commodities. That's the name of the game on this, especially on the precious metals front. This is gold's decade. The era, the decade of gold, the golden age is here, my friends. I'm not saying this because I'm trying to peddle gold, and I'm not a gold bug. I'm just saying the conditions are there. This is the perfect storm ready to happen. And the Fed is going to be, it's a crisis of the Fed's own creation. The Fed is Victor Frankenstein, and it's created the monster, and the lightning bolts are about to jolt and wake the monster to life. This thing is happening, folks, and unfortunately speaking, I just don't think the policies, the political will is there to do the correct policies on the fiscal front to counter this. Guys, thank you for watching this video. If you like the content that I provide, make sure you show me some support. Click the like button, subscribe to my channel, and let me know what your thoughts about all this. I'd love to learn something from you as much as you've learned from me, and give me some ideas on what to cover next. I know that the next video I'm covering is going to be the Producer Price Index Report. Stay tuned for that. I believe the producer prices are going to come out on this Tuesday, March 14th, so watch out for that on my next video, and until then, I'll talk to you next time.